Okay, good morning. I think most folks have been able to get through the portal. So why don't we begin? Welcome to the December 2021 UCLA Anderson Forecast Conference. We have a great program for you today, including a panel of scholars, really distinguished scholars, who are experts on debt, inflation, and the value of the dollar. And that'll be the second half of our program. Our program today is jointly sponsored by the FINK Center for Finance here at UCLA Anderson. So 2022 is just around the corner, and that's a milestone for us. It's our 70th anniversary. The UCLA Anderson Forecast was begun by Professor Robert Williams in 1952. And so we have some events that are going to come up next year. And we're hoping to have Professor Williams' son, who's an architect, he lives in Seattle, join us for some of these events. But we also have two new initiatives that are going to mark our 70th year. And the first is, as of January 1st, we have our Forecast Fellows program, and it will go live. This is a program to mentor Cal State students from Los Angeles's underserved communities in research methods, and it's a way of enhancing their path and providing new pathways to graduate studies for these students. So it's a really exciting program. You're going to hear a lot more about it. We'll be introducing our fellows in March. But I do want to take the time today to thank Edison International for providing the generous support so that we could do this program, and the folks at Southern California Edison and the faculty and staff of Cal State Dominguez Hills for their work in helping bring this program to fruition. The other event that's going to occur at the Forecast in 2022 is the inauguration of our Board of Advisors. We now have, in fact, we have in the audience with us today some of our founding Board of Advisor members. This is a board that's going to really help us as we grow through the next 70 years. You all didn't know that you signed on for 70 years. In advising us on our research program. It is a board made up of senior executives across all sectors in Los Angeles County. And we're really excited to have the new Board of Advisors join us. So you'll hear more about that coming up. The program today is going to begin with the forecast, and we'll start with the US forecast. That will be given by Leo Feller. Leo joined the forecast after some time at Johns Hopkins University, and then in the consulting world, he has his PhD from Brown University and leads our US forecast team. I'll follow that, and I didn't introduce myself for those of you who don't know me. So I'm Jerry Nicholsberg. I'm the director of the forecast, and I lead the California forecast team. And I will be following Leo with the California forecast. Then we're going to look at two major regions in California. Lila Bengali will be next. And Lila is going to talk about the Bay Area. Lila joined us out of Yale University. Her research interests are in the area of behavioral economics. So Lila is going to be an important component of the mentoring of our forecast fellows. And then we're going to finish up the forecast part with William Yu. William came to us from the University of Washington, where he earned his PhD and a stint in Minnesota teaching, and found that Minnesota was too cold, amongst other things, which is something that I'll talk about when I talk about migration and housing in California. And then we'll have time for Q&A. We'll take a break, and then our panel of scholars will join us. So before we start, I'd like to thank our sponsors. You know, we're a public institution. We could not put these events on without the generous support of our sponsors. And our sponsors have been with us really through the hard times of this last recession, and we are most appreciative of their support. So for today's program, Our principal sponsor is RSM. Our platinum sponsors are the law firm of Allen Atkins, Cathay Bank, Clark Construction, Leap Development, and University Credit Union. At the gold level is the Bank of California, California Bank and Trust, California Steel Industries, Venture Forward by GoDaddy, Robert Half, and Wells Fargo, the private bank. Silver level is Hathaway Dinwiddie, Landsea Homes, Pacific Western Bank, Union Bank, the private bank, and United Airlines. Bronze level, Cal Private Bank, Hanmi Bank, and HDR. At the Bruin level, we have Gerber Kawasaki Wealth and Investment Management, Point Wealth Capital Management, and SoCal Gas. Our media sponsor for this event is the Los Angeles Business Journal, and our academic sponsors, UCLA Extension and Anderson's Investment Finance Association. And we have 2 members of the Investment Finance Association who are going to be monitoring Slido. So as you have questions, please post them on Slido, and you have the Slido access number in the email that you received. And our MBA students, our brilliant MBA students who are here with us, will be looking at Slido, and we'll be asking the questions on your behalf. And so finally, before we turn to the forecast, I want to thank our staff, Seth Katz, George Lee, and Mina Prieto. They're the behind the scenes people who actually make this work. And so we are appreciative of their efforts. So with that, let me turn it over to Leo. Leo, what is happening in the US economy?
Jerry, thanks so much for that introduction. So let me talk about what's going on in the US economy. The big story right now is what's going to happen with the Omicron variant. Is it going to be severe? Is it going to be no big deal? And so there is a lot of uncertainty as we wait to get more information to figure out whether or not Omicron is going to cause a slowdown in growth, just like the Delta wave did. So we're forecasting that we're going to end 2021 with 5.6% growth. And that growth will be slower in the first quarter of 2022 because of some Omicron effects. So if you remember, back in March of this year, we were forecasting around 7.5% GDP growth. We ended up with 5.6. Why? 3 factors. Factor number 1 has to do with the Delta wave. That slowed down economic growth during the 3rd quarter of this year. Factor number 2 has to do with labor supply, right? So labor supply did not come back the way that we thought that it did, or that we thought that it would. And that just meant that we had labor shortages, companies having a hard time finding workers. And reason number 3 has to do with supply constraints, right? So we would have consumed a lot more if it were easier to get goods through the ports. So that's why we end up with 5.6. Now, there's a silver lining to that, which is slower growth in 2021 means that there's still room to recover quite a bit and get back to trend throughout 2022. So we have higher growth in 2022 of 4.2%, and then getting back to trend by the end of 2023, 2.7% overall. But if you look on the right-hand side, the way that this is spaced out is that we're expecting a very robust quarter right now, around 6.9% annualized GDP growth, as we recover from the Delta wave this quarter. The data are very positive, right? Labor supply is picking up, supply constraints are beginning to ease. The economy service consumption has really accelerated during this quarter. So that's good news, right? 6.9%. But then we're forecasting this 2.6%, right? The slowdown because of concerns related to Omicron. Now, this might come about, this might not. It depends on how severe the cases are with Omicron, how transmissible it is. And so far, what we seem to be learning, but it's very preliminary, is that it's more transmissible but less severe. This data is coming from South Africa, where the population is younger than in the US. So it's not clear how this will impact an older population like we have in the US, right? Following that, we're forecasting this 4.5 and 4.6% annualized growth in the 2nd and 3rd quarters. The same way we had a recovery after the Delta wave, we're forecasting that if we do have an Omicron wave, we will have a recovery thereafter where service consumption picks up, and then we get back to trend. In terms of what this means about GDP levels, how long does it take us to get back to where we would have been but for the pandemic? Our forecast is that we have already achieved the pre-pandemic peak in the second quarter of 2021, and we will get back to the trend, that light colored line of where we would have been by the third quarter of 2022. That's a very fast recovery, one of the fastest recoveries we've had in the past 50 years of recessions, right? So overall, the economy is doing okay, much better than we thought it would have been doing back when the pandemic hit in March 2020. In terms of where this is coming from, let's break it down into consumption of goods and consumption of services. So if you look at overall consumption, that's the green line at the top, we're already back at trend. Consumers are consuming about the same amount that they were consuming, on trend had the pandemic never happened, right? Slightly above. But the composition is very different. We're still consuming fewer services, and we're consuming a lot more goods. So when you think about, as Jerry is going to mention, the number of ships sitting out of LA ports, a lot of that has to do with the amount of goods that we're now consuming. Much of this is going to be imported goods, some produced domestically. But this is what's leading to these supply constraints. The ports are actually processing a lot more goods. A lot more goods have to go from ports distribution centers and make it through our logistics networks to be able to get to consumers' doors. And so our expectation is that as the economy normalizes, as we get back to going out to restaurants, to consuming services, to consuming entertainment, services will go back to trend, but that means the money that we're spending right now on stuff, buying stuff, is going to go towards services, so we're going to be buying less stuff. So over time, this is why we're forecasting services goes back to trend, goods goes down back to trend. This means that what's contributing more to economic growth is services, right? Services is picking up, goods consumption actually is easing a bit. And that means that goods consumption is contributing not so much to economic growth, it's really being driven by service consumption. What does this mean for employment? So first of all, the easy gains in employment have already happened, right? We've had, over the course of this past year, some large gains, million plus jobs gained per month in June and July. And so some really robust gains in employment numbers that have brought down the unemployment rate right now to 4.2%, right? From 6.5% that we had at the beginning of this year. So, a very rapid reduction in the unemployment rate, large gains in payroll jobs. What we're forecasting is that this is going to ease up a bit, right? We've added 565,000 jobs on average over the past 6 months, every single month. Our expectation is that this is going to get down to the 200 to 400,000 a month range into next year, and then back to the normal numbers that we tend to see when the economy is at full employment. So that by 2023, we're really adding about 70,000 to 200,000 jobs a month. The unemployment rate that we're forecasting goes down from 4.2% right now to 3.4% by the end of 2022. At that point, in 2022, we're basically at what we consider full employment. We're back at pre-pandemic levels or even better than pre-pandemic levels of unemployment. And so when we think about what the Federal Reserve will do, the Federal Reserve's mandate of inflation and controlling prices, so controlling inflation and full employment, if we're at full employment, that also means that a bigger priority becomes controlling inflation. I want to dig into these jobs numbers a bit. So when we look at this, we saw these big gains of 565,000 on average in these last 2 quarters of the year, Q3 and Q4. But something really interesting happened this past Friday, which is we got what the media considered a pretty terrible jobs number. 210,000 jobs were added. We were expecting above 500,000 jobs. And so I want to, before I leave this section talking about employment, give a caveat about these jobs reports, which is something weird is going on in how we calculate employment in the economy. So there are 4 panels here. We are looking at 2019 and 2021, right? 2019 being the normal year, 2021 being the anomaly year. At the top, we're looking at seasonally adjusted numbers. At the bottom, we're looking at not seasonally adjusted numbers. And this is how many jobs are being gained every single month, depending on two surveys. The blue is the establishment surveys. We ask firms how many people are on your payrolls. The orange is the household survey. We ask people, do you have a job? Now, what happened in November of this year, last Friday, is that firms said that they added 210,000 payroll jobs. But 1.1 million people said that they had gotten jobs, right? So why the disparity? And the answer has to do with seasonal adjustments, because what the top is doing is it's basically saying, all right, well, how many jobs are normally added this time of year? There's normally seasonality. Around October and November, we tend to hire more people so that we are having more workers in preparation for holiday sales, in preparation for people going out more in relation to the holidays. And so there's normally a boom anyway, right? So let's control for the fact that there's seasonality. As it turns out, there's normally a decline, and you can see this in the bottom graph where you see January, this big decline in employment. There's normally a decline in January when firms lay off a bunch of the workers that they hired as surge employment right before the holidays. So these seasonality controls during the pandemic are behaving a little bit weird because our consumption patterns have changed during the pandemic. So take a look at what happened in June, right? Here in June of this year, the establishment survey said that they hired a bunch of people, and the household survey said there was no additional employment, right? Here the numbers were about 1 million people in the establishment survey and 0 in the household survey, right? The reverse happened right now in November. The establishment survey said 210,000, people said about 1 million, right? So we have to be careful with these numbers right now. When we look at the not seasonally adjusted number, we see that it's about 800,000 jobs that were added on both of these surveys, household and establishment, right? And when we look at this, we say, okay, we are likely going to see large corrections to these payroll jobs. Just because it went down to 210,000 jobs does not mean that the economy is decelerating. It's just the economy is behaving atypically right now. So let me show you a lot of the corrections that have happened to the jobs reports numbers. And if you look at these two circles, this is going to be for August and September, you can see that we got an initial jobs number of around 200,000 in August. Then we got a revision that added another 200,000 jobs on top of that, right? And so the true number was 400,000 jobs approximately, but the initial number that we got was 200,000. And this led to a little bit of a freak out that the economy was not on a good track, that the economy was not recovering. And the answer is no, the economy is recovering. We just don't have the same ways of measuring it accurately as we did during normal times before the pandemic. But nonetheless, all that said, even though employment has been recovering, we're still getting slower gains in employment than we were expecting overall, right? And the big kicker here is labor force participation. So labor force participation was at about 63% of the 16 plus population. It's now at about 61.7%, right? That's a decline of 4 million workers. So while we were forecasting that this participation rate will increase, by the end of our forecast horizon, it does not get back to that 63.2%. This means that some people have permanently left the labor force. We don't expect them to be coming back. Well, where are these permanent leavers? So on the left, and we talked about this during the last forecast seminar, it's that retirements have picked up. And so retirees have left the labor market. They're not returning even as the pandemic has waned. We have about 2 million more people that have retired than the trend line would have shown. Right now, some of this would have happened anyway. Some of this are boomers that stayed in the labor market a little bit longer, and then the pandemic hit and they finally retired. But some of this is good news, right? It means that people are okay. It means that retirees, different from what happened in 2008, 2010, where people's equity values fell, where people's home values fell, right? In this recession, equities are up, home values are up. And so this has allowed people to actually retire and not need to work. And so that's some of the reason for the decline in labor force participation. The next one that I want to point out has to do with real wages since 2016. So what you can see here this is index of that real wages is set at 100 in 2016. Right before the pandemic, real wages were about 3.9% above what they were in 2016 in real terms, in terms of what people could consume. Then we get up to right now, we are at 15.2%, right? So a gain of slightly over 10 percentage points, right? Some of this is compositional. Some people left the labor market, lower wage workers left the labor market. And so that means that on average, the remaining workers have a higher wage. But right now, with 4 million workers gone, the previous point that I made, that's only 2.6% of the pre-pandemic number of payroll employees. So you lost about 2.6% of pre-pandemic payroll employees, but your wages on average for everyone else is about 10 percentage points higher, 10% higher than before the pandemic. So the other point of composition that's driving this is that even the jobs that people have now are higher paying jobs. It's not just that in the same leisure and hospitality sector, wages have gone up. It's that people have gone from working in restaurants, working in bars, working as hotel maids, to working in distribution centers, working in warehouses, working in logistics, which are higher paying jobs, right? There's been a lot of discussion about Amazon and Amazon driving up wages for workers in the areas where it's a dominant employer. Because if Amazon is paying $18 an hour, you have a choice of working at a restaurant for $10 an hour or working for $18 an hour at an Amazon distribution center. That means that you shift over, and this is the compositional effect. It also means that that restaurant has to start paying more to be able to attract workers. So it's two factors coming in. But if you're earning more, one of the things that we're also seeing in the data is that there are fewer multiple job holders. If you can have one job that pays you well, you don't need to have two jobs that pay you a mediocre wage. And so what we're also seeing when we look at payroll jobs, the payroll employment numbers, is that there are fewer people holding multiple jobs. When I show up in the establishment survey, if I have two jobs, I count as two people, right? I have two payroll jobs. In the household survey, if someone asks me, hey, do you have a job? The answer is yes, right? I count as being employed, that counts as one. Right? And so there's also a difference there in terms of the number of jobs that people have. That has gone down in this recovery, in part because people are getting better compensated, in part because people got a lot of fiscal support during the pandemic. That means that savings are up. There was a New York Times report yesterday talking about how much savings people still have in their bank accounts. And that means that just people are better off. They can afford to retire. They can afford to have only one job. And that's also contributing to this decline, both in labor force participation, but also in this job shortages, that it's hard for employers to find workers. Okay, the other point I want to talk about is the consumer sentiment index. And so one thing that we see is that consumers are actually fairly miserable right now, more miserable than they were in March 2020 at the beginning of the pandemic. People just aren't happy with inflation, with the state of the economy. And the question is why? The labor market is doing well. The economy has had one of its best years of growth in the past 30 years. Why are consumers so miserable? And the answer has to do, this is a consumer sentiment index. If you ask a consumer, do you want to go out and buy a household durable, a washing machine, a couch? The answer is, it takes me 6 months to get a couch right now. Like, no, I don't want to buy a couch right now. Like, do you want to buy a used car right now? The answer is also like, no, there are not many good options of used cars or new cars right now, and they're really expensive. And so what the consumer sentiment index is actually picking up is that consumers would rather wait to buy something when it's more available and later on. They're saying this isn't a good time to purchase. Normally, what the consumer sentiment index picks up is, I'm not sure if I'm going to be able to pay for my car because I'm not sure if I'm going to be able to be employed, so I don't want to go out and buy a car right now. And so in every recession that you see prior to this, the dip in consumer sentiment happens before an economic recession, right? People are wary about the state of the economy is actually declining. People don't feel good about it because they're not sure that they're going to have the wages to pay for their household durables, for their car purchases, for their homes. Right now, this is different. People have the ability to pay. It's just that these items aren't easily available or there's not enough options. All right, moving on. We are forecasting high but slowing inflation, especially as oil prices come down, right? So right now we have oil prices at around $76. in the fourth quarter of this year. It has started coming down with Omicron concerns, whether or not there would be a slowing recovery. There's also the fact that as long as oil is above $60 per barrel, it's profitable for about 90% of oil producers in the US to ramp up production, right? The break-even point at that 90th percentile is $60 per barrel. So above $60 per barrel, right, we expect a lot more supply of oil in the economy, in the US economy. The usual is 11 million barrels per day. We're at about 8 right now, right? So as we get additional supply because of these higher oil prices, we expect oil prices to come down. And so our target is that we'll get to about $56 per barrel by the end of 2023. This factors into inflation, right? One of the big drivers of inflation and consumer sentiment really is what's happening to oil prices. And so our inflation forecast for the CPI is that we'll actually have, considerable more inflation than we're used to in the fourth quarter of this year, 5.8% year over year. But that's declining to 3.4% by the end of 2022 and declining to 2.8% by the end of 2023. When you exclude food and energy prices, it gets to around the same level, 2.8% by the end of 2023. Now, this is still above the Federal Reserve's 2% target for a different measure of inflation, PCE inflation. That's also at around 2.7, 2.8% by the end of 2023. So this is the way in which we think inflation is going to be sustained, right? This isn't hyperinflation. This is slightly above the Federal Reserve's target by the end of 2023. One factor that is encouraging on inflation is that because consumers are delaying purchases, right, of cars, of household durables, this isn't driving this upward spiral in prices. Usually the concern that we have is that if consumers think prices are going to increase, they start consuming now to be able to get a product more cheaply. But what consumers are saying in the consumer sentiment index is that this is not a good time to buy. They would rather wait to buy later when the conditions are better to buy. So that's encouraging news that suggests that we're not getting into this spiral of consumers accelerating purchases, which causes even higher prices. All right, in terms of residential real estate, it's beginning to level off in terms of slower price appreciation. So it looks like we've seen the peak, we're beyond the peak. We expect to have around 14.5% year-over-year price appreciation. This is in the right-hand side, getting down to 6.2% and 4.8%. And so first, high prices are dampening demand. And so that means that not as many buyers are out there trying to bid up the price of housing, which means that you're not getting as much price appreciation. Rising mortgage interest rates will likely slow down the rate of appreciation. For home builders, given that prices are so high, right, you'd expect a lot more building than this 1.6 that we have right now, at 1.6 million units of housing starts per year, leveling off to 1.57 by the end of 2023. But home builders are facing supply constraints. It's hard to get construction workers. It's hard to get land. It's hard to get permits. It's hard to get lumber, right? And so that is dampening the amount of housing that they're able to build. I am out of time, but let me go through very quickly in terms of rebounding vehicle sales. So one of the other things that we saw during this recovery is that there were supply constraints related to chip manufacturing. And so that meant that we had this big decline in new vehicle sales, right? We went from about 17 million units at an annualized rate to about 14 million units right now. Our expectation is that by the middle of 2022, these supply constraints are easing. Manufacturers have already started ramping up production. It takes a while between production and sales, but we've already seen GM, Ford, Nissan, Toyota Volkswagen announce that they have been able to ramp up manufacturing because they've been able to get the chips that were in short supply earlier this year. Our expectations that the Fed is accelerating its taper. It will end tapering by March. It will start increasing interest rates by June of 2022, with the first increase happening during the June meeting, and that it will do 2 to 3 rate increases over the course of this year. Again, this is because we've met the unemployment rate that we had prior to the pandemic, and the bigger concern right now has become inflation, right? And so this is where we have this expectation that the Fed is going to begin acting this year, and they've mentioned it in several Federal Reserve speeches. All right, so to end, the pandemic is really in charge of the economy, right? We have made assumptions about what's going to happen with Omicron. If cases are more severe, if there's more hospitalizations, we're going to find out whether this will be the case in the next month or so. Then we expect a recovery that's much slower over the course of the first quarter of this year. If that's not the case, then we expect a much faster growth during the first quarter. So we have to wait and see, right? Closures in other countries may exacerbate the shortages that we're facing. That's going to contribute to inflation. And right now, there's a lot of optimism. We're getting good data coming in from South Africa, but there's also a lot of uncertainty. So our forecast for these 2 quarters has more uncertainty than usual, but we're pretty confident about the longer term trend that the US economy is actually doing well and will be growing at a faster rate than what we were seeing even before the pandemic. Thank you.
Thank you, Leo. Okay, so now we turn to the California forecast. And the way in which we do our forecast is we first do the US forecast, which Leo just went through. And then we look at California and say, well, how is California different? Well, of course, it's different in many ways, but California is a big part of the US. And so we're looking for what factors might change the US forecast as we move to California. And so you have this image here of a couple of moving vans headed for the border. So one thing that might make the California forecast different from the US forecast is the outmigration of people. And in 2020, that amounted to, so this is domestic migration out of California, 250,000 Californians left net for other states. So we're going to dig into that a little bit later on. But first, what I want to do is go through where we are with employment. That's going to give us some indication of where we're going. And then turn to a number of sectors, one weak sector and some strong sectors that are going to be driving the economy, address this question about migration, and finish up with the forecast. So just diving in here with where are we in terms of employment? You see the big dip there in the recession in 2020, and then employment starts coming back. And this is non-farm payroll jobs. So you remember Leo was talking about 2 different surveys. This one is payroll jobs. And we've recovered over 1.8 million payroll jobs in California. So pretty good recovery, fast recovery, but we're still missing 890,000 jobs in California. So a ways to go. We're only 2/3 of the way back to our pre-pandemic peak, and that's not even back to the trend. Where are these missing jobs? Well, let's take a look by sector. And so what you see in this graph is the change in jobs from February 2020 to the latest jobs report we have for California, which is October 2021. And on the left-hand side, there are 2 of these blue where, in fact, those sectors added jobs, and that's logistics. So that makes sense with the shift to online shopping. And it is professional, scientific, and technical services, that's tech. But what's really of interest here is over on the right-hand side, these 4 sectors. And they are education, leisure and hospitality, other services, which is where personal care services lives, and retail. And what characterizes those 4 sectors is that in order to deliver the services that they produce, they need to have a high degree of human contact. So this is all about the pandemic, right? But what may surprise you is adding up those 4, that's 92% of those missing jobs. So it really is all about the pandemic. We thought we were going to have faster recovery in these jobs, but then Delta happened. Now we have Omicron. That slows down our forecast. What's happened in the last 3 months? So this is the gain from July through October. The first 2 blocks that you see there that are in black, those are education and leisure and hospitality. So they are coming back as the California economy opens up, as more people are vaccinated and feel safer to go out. But we still have a long ways to go, as you saw from the previous slide. The next 3 are administrative services, which includes tech consultants and temps. And of course, temps are the first ones hired as an economy starts growing out of a recession. And then the next two, professional, scientific, and technical services, and information. So tech led the recovery from the last recession, from the Great Recession of 2008, 2009. Looks like it's going to lead it again. That's a strong part of our economy here in California. So let's look at some sectors. And in particular, I want to look at leisure and hospitality. A big component of that is tourism. And important in our tourism industry are the international tourists who come to California. In 2018, 1.8 million Chinese visitors came to California. Today, it's almost zero. And the Chinese government is discouraging people from coming to California as part of their zero tolerance policy. If you do come to go to Disneyland, you go back and you have to spend 2 weeks in a hotel at your cost, or in some cities, 3 weeks. And so they're making it very difficult to come. And we don't expect to see them in the next 12 months, as well as other international tourists. And what's the data on that? What you see in this graph are the international arrivals at LAX, that's in red, and SFO, that is in black there. And it's all relative to December 2019, seasonally adjusted. And we're down to 60%. And that's something that we don't expect to come back. What we do see is domestic tourism. So for example, in the North Bay, in wine country, Sonoma and Napa Valley, hotel occupancy rates are up in the 60%. So we're traveling domestically, shorter trips, closer to home. That's going to make up part of it, but not all of it. So this is a weak sector that's really going to hold back growth in California. Moving to logistics, because we saw the jobs added in logistics. And this is a picture, if you've been out through Queens Gate from the Port of Long Beach, you've seen this. You can practically walk across the ships to Catalina. What happened to the ports? And by the way, just as a digression, in our March conference, we're going to focus on this. We're going to focus on international trade in the ports. But what's happened? Why did the ports fail? Well, let's take a look at the data. The top line here in red, those are containers that are coming through the two giant ports of Los Angeles and Long Beach. The bottom two are Puget Sound and San Francisco Bay ports, much smaller, so they're on different scales. But what you notice on that red line is that the ports of Southern California are processing and getting off ships more containers than they ever have. But there's still a lot more to take off the ships. And the supply chain problems are really getting those containers out of the ports and out to retailers. That's where you're getting the jam up. It's not so much the ports themselves, because they're processing a huge amount of goods. And we expect that to abate. As Leo said, there's going to be fewer goods purchased as we move forward and fewer foreign goods. So what this means is two things for our forecast. First of all, logistics is going to remain strong, hiring in logistics. Second, because so many goods are coming in, we expect construction of warehouses, construction of industrial space to remain strong. And we've just finished the Alan Matkins UCLA Anderson Forecast commercial real estate survey for a number of different kinds of commercial real estate. And that's coming out in probably 3 weeks. And what it says about industrial space is that that's not only a hot sector, it's going to remain hot. And so that's a source of demand for construction workers. Also, I urge you to read it, that we have some really interesting results on what's happening in the office market. So that's going to be out in about 3 weeks. Now, turning to California housing prices and domestic migration. And I kind of like this cartoon. Usually it's last one out, turn out the lights. But this is leaving California, and that sign there, in case you can't see it, says last one out, turn off the windmills. But that was kind of cute. But the more serious point here is migration affects economic growth. And so it's going to affect our forecast. And what we want to focus on is migration because of high housing prices, right? There are lots of reasons why people leave California, lots of reasons why people come to California. We just want to focus on the high housing prices. We hear a lot of statements of people saying, California housing is unaffordable, I'm moving to Phoenix, et cetera, okay? So that's what we want to dig into. And indeed, home prices are at record highs. What you see on the left-hand side is the Case-Shiller S&P Home Price Index. It's for San Diego, Los Angeles, and San Francisco. It's same homes being sold twice. That's how they measure the price increases. And it's through September. This is an index. And so this has been all normalized to 100 in 2016. That's why all the lines are together, because the home prices in those cities are certainly different, right? And as you move your eyes from left to right, you see home prices are appreciating. And then in the last year, it accelerates. And on the right-hand side is the California Association of Realtors median home price. And you see the same pattern. So clearly what's going on is California is becoming less affordable. And people are leaving. As I said, 2020, 250,000 people left California net, 250,000 left. And we want to ask the question, where, if at all, does it stop? And I like this picture here. This is from the New York Times Magazine. And it's all about the crazy market, housing market in Austin. And that leads to this. It's all relative. And that's what's going to get us to where does it all stop? What do I mean by that? Well, if you think about, I don't know how many of you have been in Phoenix or Houston in July, but if Phoenix and Houston were as unaffordable as Los Angeles, you wouldn't expect Angelenos to be migrating to Phoenix and Houston. You'd expect the other way around. So it's not the fact that LA is unaffordable, it's that LA is unaffordable relative to these other cities. And so what we're going to do here is look at 1990. So California housing has always brought a premium because of California's weather, beaches, mountains, et cetera. And in 1990, that premium was such that the net migration from California was about 0. So we're going to compare what's happening today in terms of relative affordability, or if you wish, relative unaffordability, to 1990 and see where we're at. And the first thing we're going to look at is Los Angeles relative to Phoenix, Las Vegas, and Austin. So that's going to be this picture. On the left-hand side, you see everything's at 0. That's the 1990 premium. So Los Angeles housing was more expensive than Phoenix in 1990, but the premium is what we're zeroing in on. And then we had that first dip there, and that dip is due to the aerospace contraction, a very soft housing market here. And then you have the speculative bubble that happened in housing. But look over on the right-hand side. And so this is kind of over the last decade. And Las Vegas is the top line there. The premium went way up. It's been coming down. But here, look at this. This is Phoenix. The premium relative to 1990 for Phoenix is now 20% lower. And Austin is 40% lower. What's been happening there? Home prices have been going up much more rapidly than in California. Those cities are becoming much less affordable, which makes Los Angeles relatively more affordable, right? So let's turn to the Bay Area. The left-hand side is San Francisco. The right-hand side is Silicon Valley, and they're compared to Seattle, Boise. The third one is going to be Austin and Nashville. And just look over on the right-hand side in both. They're negative also. So the premium today is below where it was before. Now, part of the reason is that these cities were small cities. They didn't have as many job opportunities, not the right kind of job opportunities, not as many cultural amenities. And these cities have been growing up. And as they've been growing up, they've been becoming, in terms of home prices, more and more like California cities, which has reduced that premium. What about cities that were mature in 1990? How's that been affecting migration? So let's look at Dallas and think about Atlanta. So those are two cities that were, fairly decent-sized cities in 1990. We're going to look at Dallas here. Oh, before we do that, let's look at what people are saying in these cities that are growing up. So this is Boise. Home values go from affordable to unattainable. Valley families are feeling pressure of the affordable housing crisis. That's Phoenix. Austin's affordable housing crisis has city leaders ready to take action. And the last one is Seattle. The magnitude of our housing shortage requires more action. So in each of these cities, they're recognizing that affordability or unaffordability is becoming a real issue, right? So we're seeing it in those cities, we're seeing it in the data. So what about Dallas? So this is the same graph, just highlighting Dallas. We have the aerospace contraction, we have the speculative bubble, which didn't really happen in Dallas. And then it settles in here at about 2 to 6% premium over 1990. And during this period of time, net migration went down to, for the entire period of time, went down to 6,000 out migration from Los Angeles to Dallas. So that's a number that has surprised me. I think it'll probably surprise you. Plenty of Angelinos moved to Dallas, but plenty of Texans moved from Dallas to Los Angeles. And so that premium seems to be just right in there to keep migration at basically zero. If I showed you this for Atlanta, you'd see that over the same period of time, about 35 to 40 households net moved from Los Angeles to Atlanta, right? So these cities that are growing up are still receiving migrants from California, but they're becoming relatively less affordable, and we're moving towards less and less migration. And that's what we're building into the forecast. So to summarize, job loss remains concentrated in human contact sectors. And the two waves that we have now that are kind of merging together, Delta and Omicron, they're delaying the recovery. We've made an assumption here, purely an assumption, and our ability to forecast Delta and Omicron was 0, so we don't know, but we made an assumption that successive waves of the pandemic are going to have less and less effect on the economy. But because of these two, we've got slower growth in California, and as Leo said, slower growth in the US. But in California, tech, and California is disproportionate in the tech industry. Logistics, also disproportionate relative to the US. And construction, they're going to drive California's economy. And because these are growth sectors all throughout the US, but more so in California, we're expecting California growth to be faster than the US. And how does migration enter into it? We have net domestic migration from housing costs is going to decrease as California housing, as unaffordable as it is, becomes relatively more affordable. So just to turn to some numbers, employment 3.4% this year, most of that's already baked in. And then we have, getting a phone call, somebody wants to know, should they buy or sell? So we have employment going down to 2.9%, growth in 2023, still strong employment growth. That's going to drive the unemployment rate down to 4.4%. Housing is going to buck the US trend, and we're going to get up to 140,000 homes. Relative to affordability is not going to really move the needle. But we're bucking the US trend because of the new laws that have been passed that allow things like ADUs in backyards in formerly zoned single-family neighborhoods. So we'll get more housing in California. We won't really hit the affordability numbers. And then on migration, we have migration this year, 154,000. That's a negative, declining to minus 13,000, or basically zero. Part of that is what we just went through. And part of it is during the last 4 years, we had very little international immigration to the US. And a disproportionate amount of that comes to California. We've already seen an expansion of the quotas for international migration into the US, and more is expected. So that's built into our forecast, which takes us down to zero. We're going to have more than minus 13 in net domestic outmigration, but we're moving towards zero as those premia come back down to that equilibrium like we saw between Dallas and the US. And that concludes the California forecast. And so what I'd like to do now is turn it over to Laila Bengali to talk about what's happening in the Bay Area. Laila.
So I'm going to talk to you today about what we're seeing in the Bay Area economy. I'm going to give an overview of where we are and talk about a couple of different factors, including labor markets, look at regional variation, variation across industries. And then as I go through this, I'll be building the case for our forecast, which I will get to at the end. So a good place to start to get an overview is to look at total non-farm payroll employment, or total non-farm payroll jobs, if you will. That's what you're seeing here over a relatively long time frame for some perspective. And what you can see is that after February 2020, payroll employment in the Bay Area fell substantially, about 562,000 jobs. As of right now, and right now includes data up through October of 2021, still about 241,000 down from pre-pandemic levels. Before I go on, just so we're all on the same page for the purposes of this presentation, the Bay Area is defined as the 7 counties around the Bay. So to think about why we're seeing the pace of recovery that we are seeing, it's helpful to look at labor supply and labor demand. This chart is showing you one way to look at labor demand. It's the labor turnover, 4 different kinds of labor turnover as a percent change relative to February of 2020. And the reason I'm doing this is because I want to focus on recent trends and patterns that we've been seeing in the last couple of months. So we're going to focus on the right-hand side of the chart. First, this top blue line, this is job openings. And what you can see is that job openings have been increasing. We'll skip down 2 and go to this gold line. This is hires. Hires for a while have been relatively flat. This is indicative that there's a rise in demand for labor that's not being met. At the same time, the supply of labor has not recovered. This is showing you the labor force as a percent change from February of 2020 for the Bay Area and also California and the US for comparison. Now, the labor force is a measure of the supply of available workers because the labor force is defined as the number of people who are employed plus the number of people who are unemployed. So those are people who are looking for a job, don't currently have a job, and are available to start a job. And what you can see is that in percentage terms, the Bay Area has recovered less in terms of labor force. In October of 2021, there were still about 107,000 fewer people in the Bay Area labor force relative to February of 2020. So it's helpful to think about why this might be. Now, there are a couple of reasons. Leo mentioned some. I'll talk about a few others very briefly. One is essentially remote work, or a change in where people are employed officially versus where they're doing their work. So for example, if a tech worker at a Silicon Valley tech company or San Francisco tech company is now working remotely, perhaps temporarily, perhaps permanently from, let's say, Santa Cruz, that individual is technically not in the Bay Area labor force because labor force is based on where you live. Other possibilities include kind of a discouragement story where individuals may be staying out of the labor force because they believe that there aren't jobs in their preferred industry or occupation, so they just don't look for work and they don't have a job, so they're not in the labor force. There are a couple of other reasons which are a little bit more permanent, I think. One is retirement, as Leo mentioned. Another is a transition from a dual to a single earner household, perhaps prompted by childcare or child education needs, and supported by the large amounts of government stimulus that increased personal incomes and gave families more of a cushion financially. And finally, another possibility is migration. This certainly can't be ruled out. Jerry talked about migration. There is some evidence that there was more net out migration from the Bay Area in 2020 than we had seen in previous years. That research comes out of the California Policy Lab. That's a research group within the UC system. There are also estimates from the California Department of Finance that have more net out migration in 2020. And I think we'll really know more when the 2021 official numbers come in and previous years are also revised. So migration is certainly a possibility. So putting this together, I talked about a rise in the demand for labor, a reduction in supply. That's going to put upward pressure on the price of labor or wages, which is indeed what we see in the data. We've seen large increases in average weekly wages, for example. That's going to put pressure on employers to try to find ways to save on labor costs, which could encourage them to, let's say, make do with fewer workers, adopt labor-saving technologies, and that could be a headwind to jobs returning in the near to medium term. So to think more about our forecast for the Bay Area, it's helpful to compare the Bay Area to California and to the US. This is showing you total non-farm payroll employment as a percent change from February of 2020. And what you can see is that the Bay Area is lagging behind the other two regions. To think about why that is, it's helpful to split the Bay Area up into its various regions. So this chart is very similar to what you saw before, except now instead of the Bay Area overall, I've split it up into 4 metro areas: the Oakland Metro Division, the San Francisco Metro Division, the San Jose Metropolitan Statistical Area, and the San Rafael Metro Division. And what you can see is that relative to the others, San Francisco and Oakland are lagging behind, particularly relative to San Jose. To understand why this is, let's peel the onion layer back a little bit more and look at variation by industry. So there's a lot going on in this chart. On the horizontal axis, the x-axis, that's a measure of the industry's size taken as of December 2019. So dots that are further to the right are relatively larger industries. Dots that are further to the left are relatively smaller industries. On the vertical axis is a measure of where we are in terms of jobs. Now means October 2021 versus February of 2020. Particularly, it's the percent change in employment in that industry between February 2020 and October 2021. And that's going to mean that any dots that are above the 0 line, those industries have more jobs now than they did in February 2020. The yellow dots are San Jose, the orange dots are San Francisco, and it's helpful to look at both similarities and differences. So let's start with some similarities. What you can see is that for a couple of sectors, including other services, information, education and health services, and professional and business services, those sectors have seen roughly the same level of recovery in percentage terms across the 2 metro areas. The differences also help explain what's going on in San Francisco. Let's start with manufacturing. So you can see a couple of things. First, manufacturing is a much larger sector in San Jose than it is in San Francisco. And this has to do with a lot of the computer and electronics parts production and manufacturing that goes on in San Jose. You can also see that employment in manufacturing is above pre-pandemic levels, above February 2020 levels in San Jose, but not in San Francisco. And again, this has to do with the high demand for computer and electronics parts that we've seen over the past year and a half, and I guess a bit more than that by this point. Other sectors, so wholesale, and we'll add in transportation, warehousing, and utilities. This roughly represents the logistics sector. They're not huge sectors in either metro area, but in both cases, there's been more of a recovery in percentage terms in the San Jose metro than in San Francisco. Finally, leisure and hospitality, down about 29% in both metro areas, but leisure and hospitality is a larger sector in San Francisco than in San Jose. Now, these labor market patterns have implications for other aspects of the economy. And essentially, I think what's going on is a lack of office workers in San Francisco and a lack of tourists. Jerry already showed you the chart that international passenger arrivals at San Francisco is down or are down. This is the same for domestic arrivals. So not a lot of tourists coming in, or not as many as we're used to. We can also see that fewer office workers are going into their city offices. Google has put out some information telling us about visits to certain types of places. This is showing you visits to workplaces. And what you can see is that San Francisco is behind all of the other counties in the Bay Area in terms of a recovery. We can also see implications for other aspects of the economy. Leo talked about the importance of consumption. Taxable sales, which is a good proxy for consumption, that's down much more in San Francisco than in any of the other counties. And we can also see this in housing markets. House prices have appreciated more in other areas of the Bay Area and less in San Francisco. So if we put all of that together, we get our forecast for the Bay Area. This is showing you total non-farm payroll employment as a % change from the prior year. You can see that 2020, there's a big drop. And because of some of the labor market headwinds discussed in this presentation, we're expecting constrained job growth in 2021 and 2022 relative to California overall, with the Bay Area outpacing the other regions in 2023. For real personal income, again, this is a % change over the prior year. 2020 and 2021 were very strong years for a number of reasons, including the strength of asset markets and the large amount of government stimulus, which increased personal incomes. Because of that, and also because of the inflation risk, we're expecting negative growth in 2022, less negative in the Bay Area than the other regions, with positive growth returning in 2023. So I will leave you with this beautiful picture of the East Bay. If you happen to know where this is, drop it in the chat. I'd love to see if anyone recognizes this particular picture. So thank you.
All right. Thank you, Lila, for your Bay Area economic outlook. So good morning, everyone. Today, I would like to talk about Southern California economic outlook. So in this presentation, Southern California means Los Angeles County, Orange County, San Diego County, Ventura County, Inland Empire, which includes Riverside and San Bernardino counties. So as you can see, Southern California economy is big. Southern California GDP, based on my estimation, in 2021 reached $1.6 trillion. So this will place Southern California into 13th largest economy in the world, slightly less than Australia, bigger than Brazil's economy. So of Southern California counties, Los Angeles County is the biggest one. In 2021, it has $815 billion GDP, followed by Orange County, $272 billion, San Diego County, $256 billion, Inland Empire, $211 billion, and Ventura, $56 billion. So in terms of GDP per capita, Southern California as a whole, GDP per capita in 2021 is $74,000, higher than United States, $69,000. If we look at the individual county, Orange County has the highest GDP per capita, $86,000, followed by Los Angeles, $82,000, and San Diego, $77,000, Ventura, $66,000, and Inland Empire is $45,000. So there are two things to remember. Number one, the GDP per capita doesn't address income inequality issue, which actually we discussed in September conference. Number two, let's just say if the resident in Inland Empires come to Los Angeles to work, which is the case, most of the case, their work will contribute to Los Angeles GDP, but not Inland Empire. So let's say Los Angeles County's GDP per capita might be overstated and Inland Empire might be understated. So here I show you the accumulated real GDP growth since 2001. in the Southern California region and the United States. So the black line is the Inland Empire. We can see over the past 2 decades, it had a higher growth rate in the region. And the green line is the Southern California as a whole. And the blue line is the United States. We can see Southern California has a higher GDP, higher economic growth over the past 2 decades than the nation. So here, let's talk about another important economic variable, jobs. So on the left is the non-farm payroll job in the region from 2010 to October 2021. So basically, we can see a similar trend during the expansion and the decline and recovery since the pandemic. On the right, the horizontal axis is the population growth from 2010 to 2020. And the vertical axis is the payroll job growth in the same period. So we can see again, Inland Empire is leading the region in terms of population and job growth. So there are, I think, 3 reasons for this. Number one is Inland Empire has a lower housing cost. So it attracts more immigration. Number 2, more population had more housing demand. So it created more construction jobs. Number 3 is a very strong warehousing logistics industry in the era of the e-commerce. So San Diego, United States, similar population growth, similar job growth. Orange County and Southern California as a whole has a slightly slower population growth, but similar job growth. Los Angeles and Ventura both had a lowest population and job growth. So here, let's take a closer look at the job dynamics since the pandemic began. So this is the percentage change of the payroll job since February 2020. So we can see Inland Empire on the top has a faster job recovery. In October 2021, it is 2.3% below the pre-pandemic peak, followed by United States, 2.8%. And at the bottom, we can see the red line is Los Angeles County, has the slowest job recovery. So in October, it's 7.4% below the pandemic peak. Los Angeles also at the same time had the highest unemployment rate. So right now, let's look at this sector GDP. So in this chart, each bubble represents a sector nominal GDP in that region. So the blue color represents Los Angeles County sectors. Orange color represents Orange County, and green color represents San Diego. So we can see in Southern California, the largest sector to contribute to the GDP is real estate and rental and leasing. So you say, why could that be? Okay, it's not just about real estate, realtor agents. All the rental revenue for the landlord are included in this category. And this is a very big things in Southern California economy. For example, Los Angeles in 2019, this is the data for 2019, in this sector has $157 billion GDP, right? And the second largest sector is the professional and business services. So we can see, for example, in Los Angeles, it reached $97 billion. So Los Angeles also has very strong information sector because of being the center of the entertainment industry in the world. So right now, let's talk about the sector job growth. So on the left is the payroll job in October 2021. The blue bar represents Los Angeles County. Orange color represents Orange County. Green color represents San Diego. And red color represents Inland Empire. So we can see the largest sector employer in Southern California is healthcare and social assistance. Number 2 is leisure and hospitality. Number 3 is retail trade. And number 4 is education. So on the right, I show you the percentage change of the sector payroll job from 2010 to October 2021. So I rank this sector by how many jobs they had created over this past decade. So on the top, healthcare and social assistance, not only is the largest sector for the employer, it also created most jobs in the past decade. And number 2 is transportation, warehousing, and utility. So you can see these are, oh, I forgot to mention this symbol. So the blue circle represents Los Angeles County. So orange dot represents Orange County. And the green triangle represents San Diego. And the red square represents Inland Empire. So you can see the difference of the growth rate, job growth for these 4 regions. So you can see there's off the chart high growth in this sector, logistics sector, warehousing sector in Inland Empire. So over the past decade, it has almost 200% job growth. That's about almost 20% a year. And then the third one is construction, as we just say, because of low cost of land and housing. So there are a lot of migration, a lot of construction, housing boom. So it also creates a lot of job growth for that. All right, so summary. In terms of GDP, Southern California economy had a faster growth than the nation over the past 2 decades. And Inland Empire leads the region in terms of a population and job growth for 3 reasons. 1, low housing costs. 2, booming construction jobs. 3, the rise of the warehousing industry in the era of the e-commerce. And the recovery of the Southern California economy, we believe, will continue. The Inland Empire's economy is forecast to grow at a faster rate, while coastal California will be at a slower rate. So here comes to our forecast. So on the left is payroll job growth. On the right is real GDP growth. So we forecast Southern California's payroll job growth will be 3.9% in 2022 and 1.7% in 2023, which is slightly slower than the California as a whole. And real GDP growth will be 4.2% in 2022 and 2.2% in 2023, which is also a little bit slightly slower than the United States economic growth. Okay, so that's my presentation. Thank you very much. So I think right now we're going to go to the Q&A section. Right?
Yes, thank you, William. So we have a little time that we can answer some questions. We have some of our students here from the Investment Finance Association, and they've been monitoring your Slido. Did anyone ask any questions, or did we answer everyone's question?
Yep, we have a few. First, I think this was during Leo's presentation. In your inflation forecast for 2022 to 2023, is a key assumption that unions, truck drivers, port workers, and other workforce segments will keep wage increases low?
No, we still have wage increases coming into the forecast. So we don't particularly look at unions. We look at wage growth overall in the US. And our forecast is that that still remains high, that still remains strong. But you have this countervailing force, and that countervailing force is even though wages are going up, right, and continue going up, you have oil prices coming down. You have slower appreciation of housing prices. You have slower growth in goods prices as you have supply constraints easing. And so overall, on balance, that's still contributing to a slowdown in the rate of inflation, even though you have continued rapid wage growth for the labor market. That has to do with the fact that labor supply is still down, and we don't expect labor supply to recover. And also because the unemployment rate, we expect to be reaching full employment. So overall, that's a tight labor market, right? The labor market is doing well. And that means that workers are going to be able to command higher wages.
Yeah, and just another comment on that. You know, we ran some scenarios to really try and answer that question. The 2 main drivers of inflation, as measured, for example, by the CPI, are dramatic increases in energy prices. Well, 3 main drivers: energy prices, the supply chain constraints, and excluding labor, and housing costs or rental costs. And all of those we expect to abate. So yes, wages are going to go up for truck drivers. Wages are going to go up for wait staff in restaurants. These are places where you do have labor supply constraints, but that wage push inflation is not going to be enough to sort of overcome the decline in energy prices, for example.
And then another question. So this seems kind of a little anecdotal. Many service providers have been asking for payment in cash. Do you think this materially impacts the services versus goods consumption numbers?
No, I mean, assuming that people are paying taxes on the cash payments that they're receiving, right? And so the data is really based, I mean, if this is an under the table black market payment that service providers are getting, then it doesn't get counted in the data. But for the most part, we trust the data to be, based on tax revenues. And so as long as it's declarable, then, we do believe that our service consumption numbers and our goods consumption numbers are correct.
Another question. There seems to be a movement towards worker empowerment and pro-labor. There's an anti-work subreddit that has made headlines on this front. Is this a real and viable trend?
Can you repeat that question again, please?
I think so. Maybe
Or
not
interpret it?
maybe not focusing on the subreddit part, but there just seems to be a movement towards worker empowerment and pro-labor. And do you think that's a viable trend going forward?
I mean, that's also just an artifact that there is a labor shortage at this moment, right? So the fact that people's savings balances are up because of the amount of fiscal relief that we got during this past year and a half, the fact that wages have gone up, it means that workers can be more discerning about what jobs they take. And so I do think that will continue. We are in a scenario of about 4.2% unemployment going down to 3.4%. That's a very favorable situation for workers to be able to command better working conditions.
Last one in the Slido. How this is in Jerry's discussion in slides. How is the California housing price premium calculated with regards to relative price impacts between California and those selected cities?
Sure. So we start out with 1990, when there was very little net migration out of California. And so let's take Phoenix and Los Angeles as an example of how it was calculated. Took the median home price in Los Angeles and divided it by the median home price in Phoenix. Okay, and so that's going to be a number greater than 1, because median home prices in Los Angeles were greater than Phoenix. And that is representative of the premium, right? Then home prices were inflated using the FHFA home price index for each of the cities. So that was the home price appreciation as we went forward in time. And the ratio was again calculated to see what that premium was, say, in 2020. And that premium in 2020 was then compared to the premium in 1990. So that's the methodology of looking at median home prices and then looking at home price appreciation from 1990.
Great. I had a follow-up question from just the presentation.
Sure.
So it seems like you've heard in the last few months, there's been a growing concern of stagflation. And based on your presentation, it seems like the issues with that might be more supply side oriented. How do you guys look at the go forward harmonization of fiscal and monetary policy? And like just in terms of kind of fighting off that threat of stagflation?
So if anything, I'd call it boomflation. Stagflation, the stag part is incorrect, right? So when we have 5.6% growth, which is one of the highest rates of growth that we've had this past 30 years, when you have the number of employment gains that we've gotten, this is a boom time, right? It's not surprising that we're getting higher prices. And that's because the economy is accelerating, right? I really don't think we would be in a situation where if the economy was recovering very slowly, that we'd be seeing higher prices, right? We have the demand. It really does appear to be a supply issue. And that has to do with when I showed you the goods and services graphs, right? We are consuming, our pattern of consumption changed very abruptly. It takes time for the supply side to catch up. It takes time for us to expand production facilities, hire more workers, shift workers from working in restaurants to working in distribution centers, to be able to get the supply increase that will meet the demand, the increased demand that has occurred during this pandemic. So, I really don't think that we're going to get this stagflation spiral that some people seem to be concerned about. As growth slows down, that also decreases the inflationary pressure. So we get boomflation right now, right? I guess we just go back to normal later on in terms of normal growth, normal rate of price increases. In terms of what this means for monetary policy, fiscal and monetary policy, there's some concern now about creating more demand than can be met by supply, right? So if we put too much more money through fiscal policy into the economy right now, can the economy absorb that? What has been proposed so far is an infrastructure plan that smooths out the amount of money coming into the economy over the course of decades, right? As you develop more infrastructure. And that, while it's pumping money into the economy, it's expanding supply. It's about expanding productive capacity, right? If you're expanding your ports, if you're expanding your roads, right? This allows us to get more truck drivers through the ports faster into distribution centers. So it is a supply expansion in that sense that should act to put downward pressure on price increases. In terms of monetary policy, right? I think the Fed is actually on track to be able to accelerate the taper, reduce the amount that they're contributing in quantitative easing to the economy every month. And then, if it is the case that we are down at around, 3.6, 3.7% unemployment rate by June, at that point, it might start making sense to increase interest rates. So, I think that it's being well managed given the information that we have right now, that the economy is doing really well, employment has not fully recovered. Yes, we're experiencing higher prices, but we're expecting those to come down even without any kind of Fed action, just as energy prices come down, just as goods prices come down, or stop increasing as supply catches up.
Okay, I think we've reached the point where we're going to take a break. And when we come back, we have a panel of distinguished scholars who are going to talk about some of these issues, talk about debt and the value of the dollar and inflation. And so let's take a 10-minute break. And at 4 minutes, 5 minutes after 10, we will begin. And we'll see you then. Thank you.
You ready for me to speak, huh? Okay, we have some more people who are returning to this room. My name is Ed Leamer. I'm going to take off this mask so that you can see the emotions that I feel today. I feel really, really happy about being here because I'm going to introduce, do I have my slideshows going here? I get to, I'm not in control here, guys. Yeah, so I'm really happy about being able to introduce the speakers this morning. From my perspective, maybe the most important thing is these have been good friends of mine for many, many years, going back into the 70s. But from the perspective of the audience, these are two of the most knowledgeable people, most knowledgeable economists about debt issues in the whole world. We've got Larry Kotlikoff, who is on the left of your screen, who's a professor at BU, and Sebastian Edwards, who many in the audience have had courses from. He's a professor here at UCLA. Both have been around for a long time. In fact, Larry Kotlikoff was at UCLA back in the 70s. So it's a small world that we're working in. But the question that I want them to answer, I'm going to give them a more detailed question, is this a big problem or is it not a problem at all? I'm trying to make this thing move, George. There we go. That's the woman who thinks it's a problem, and there's another one who thinks not really a big deal. So, and by way of introduction, I could go over the intellectual accomplishments of these two speakers, but what I'm going to tell you is the books that they've written. So this indicates the audience that they reach. It's not just the academic audience, it's a much broader audience. Sebastian Edwards has written this terrific book about American default, the untold story of FDI, the Supreme Court, and the battle over gold. He's got a book on Left Behind, African Successes, the Economics of Crime, Lessons for and from Latin America, Current Account and External Financing, which is critical issue when it comes to economic debt. And then capital flows in the emerging economies, extraordinary breadth and depth at the same time from Sebastian Edwards. And then there's Larry Kotlikoff. He's got a new book, Money Magic. You can't get it delivered now, but you can order it on Amazon. It can be available in a couple of months. He's the world's expert in deciding when you should get your Social Security. So there's a book called You're Hired, Get What's Yours, Revised Secrets about maxing your Social Security. The Clash of Generations, that's a debt issue, because the extent to which we as Americans are pushing off tax liabilities in the future, that's an abuse of the next generation. So the generational policy, healthcare fix, coming generational storm, extraordinary coverage from both of these individuals. Now, when they speak, we're going to have Larry Kotlikoff focus mostly on the internal issues, including unfunded liabilities, which he's one of the world's expert on. And then we get to my friend Sebastian, he's going to focus more on external issues. So here's the debt questions that I want to have answered. First of all, what's the consequences of high level of debt? Is some debt good and some debt bad? If you use debt to grow your economy, then that future growth is going to take care of the debt service and drawing down that debt. But if it's just pushing off the taxes in the future, it's a form of child abuse. Is there a crisis? Sebastian Edwards has studied crises all over the world. The question is the United States cooking a crisis that could happen and turn us into Mexico or Argentina or whatever? Is the current debt as a cause of inflation? We had a discussion about inflation just a few minutes ago. I'm going to give you a somewhat different view about that in just a few minutes. And then what level of debt to GDP is worse? I mean, is there some critical level that the alarm bell should ring? We're getting that pretty high. Are we near that point now? And how does this depend on GDP growth, and how does it depend on interest rates? A high GDP growth means you can grow yourself out of the problem. Low interest rates mean it doesn't matter that much. So shows you the debt to GDP ratio. The vertical axis is percent. And so we've had a big increase in debt to GDP. This thing doesn't like me because I can't quite control it. There we go. That was the first surge from 1980 to 1990. And I don't know how many of you know that picture there, but that's Jude Wanniski. Jude Wanniski went to Ronald Reagan and said, we Republicans have a problem because the Democrats are the Santa Claus party and we're the Scrooge party. The Democrats are giving all these gifts in the form of their spending, and we're just saying balanced budget, balanced budget. We need to offer the taxpayers something, and what it should be is tax cuts. And at that moment, both Democrats and Republicans agreed that deficits were a good thing. The Democrats want to have more spending. The Republicans wanted to have tax cuts. That's actually what we've had over the last decade. The Republicans, when they were in control, they did a big tax cut. But then there was, in the 1990s, the debt to GDP fell a little bit. That's because we had extraordinary growth in the internet era, and it brought in a lot of tax revenues that helped draw down that debt. But in the last two recessions, we've had a huge increase in debt to GDP, and you can see that's up to almost 140%. That gentleman on the right is John Maynard Keynes, who's the intellectual supporter of deficit spending during periods of demand constraint. Where you don't have enough demand, you'd have to add more demand of the federal government. But we've got a supply constraint problem mostly today. And maybe debt financing isn't the ideal thing, and maybe not a Keynesian idea. Here are the highest rates of debt to GDP. Japan at the top. Japan has had this for a long time, never had a problem. What does that mean for us? Are we going to be the Japan of the future? But if you move down this list, Venezuela, Greece, Greece had a huge problem because when they joined the European Union, they could borrow at the rate that the Germans were borrowing. Because the exchange rate risk went away, they adopted the euro, and they borrowed like crazy. And then it was discovered they were borrowing like crazy, and people pulled out. And they've had a downturn like the Great Depression that lasted for a very long time. And we don't want that here in this country. If you move down the list, there's the United States in about the middle. That's a little more than 100%. Remember, we moved up to 140%. In the most recent data. So move the US a lot closer to the top. Is that a problem? I want to know Sebastian what he thinks about that. And then this is a list of the financial crises that we've had over the last couple decades. And this huge list, and Sebastian Edwards has studied many of these. And many of these are associated with sovereign debt in some material way. So the question to be addressed to Sebastian is the United States going to be like one of these countries? Or the way I'd like to talk about metaphorically is Uncle Sam starting to look a lot like Uncle Demetrius, meaning we got a Greek problem on the way if we're not careful. This shows you the federal interest payments divided by federal debt, which is the implicit interest on federal debt, and also the 10-year treasury. And you can see that it was like 12% back in the 80s, but it's been lower and lower. So the lower interest rates came with much lower levels of interest rates paid by the federal government. But because of those lower interest rates, the interest as a fraction of government receipts, the amount of that money that comes in the form of taxes, that was about 25% back in 1980. They were using 25% of the income in the federal government to do the debt service. Now it's down to about 10%, a reasonable level. So this is asking a question, is this low interest rate environment, is now the time to do more deficit financing rather than less? So for the next slide here, this image is meant to prepare you for the next slide. This slide, I want you to know we're going to look at GDP, not real GDP, but nominal GDP, which is the value of goods and services produced in the United States. That's also the income level. Because all those sales, the dollars that are coming in to make that sales, that's going to be distributed to the workers, to management, and to the owners. So GDP is also a measurement of earnings. But the federal deficit, which is federal spending minus federal taxation, by the way, this is the flow, not a debt, not the stock. So when we're talking about debt to GDP, that's a stock. This is the addition to it, the flow. That creates a sense of income on the part of the people who are not paying the taxes. So we're going to take what I'm calling a parent income, which is GDP plus the federal deficit. You'll see that in a minute. That the tax liability that's implicit in that deficit is not put on any private balance sheets. So it makes you and me think we're wealthier than we really are. So we're going to measure implicit or apparent earnings as GDP plus a federal deficit. And you're going to see, and also asking a question, how much is transfers the issue recently, and what fraction of transfers are being funded from borrowing rather than from taxation? So here's the picture. This is meant to, that last slide was meant to prepare you for this picture. The vertical axis on the left is going to be GDP. That's like 10 trillion, 15 trillion, 20 trillion. On the right, we're going to look at the percent of transfers that's financed by borrowing. And there's a little arrow there that points over to 100%. So we're going to see a picture in a minute that arrow is going to help us understand that picture. Here's GDP using the left scale. And the dark lines are the recessions. You can see GDP declines a bit in both of those. Here's GDP plus the deficit. And you can see that the deficit is adding to apparent incomes. during these recessions, but it just explodes apparent income over here on the right. And this is GDP plus transfers. That's always been kind of growing, but now it's just skyrocketed compared to current GDP. And then here's our deficit as a share of transfers. So that represents a fraction of transfers that are being funded by borrowing. And look over here at the right, we're back to normal growth in terms of GDP. But in terms of income, we're sky high. That creates a foundation, and it's all done with deficit finance, a huge amount of transfers, all financed by debt. To me, that lays the foundation for inflation. Well, why aren't we getting more inflation? In a way, you want to narrow the gap between those two lines. You want GDP to rise up to the level of income, closer to it, and you do that by inflating the economy, not by real GDP growth. So why is that? Well, here's a message. Don't give your credit cards to your uncle. That's a huge mistake. Uncle Sam I'm talking about. And then finally, what's going to save us? If that's all that transfers doesn't add up to spending, but it goes into savings, that protects us for a while. You can see this is gross private savings. The billions of dollars went up from 5 trillion up to 7 or 8 trillion dollars, a huge increase in saving. And that's going to save us temporarily from inflation. But those assets are ready to jump out and spend when the economy gets heavier. And I think we have a real inflation problem. So I end this with the question again to Larry Kolikoff, who's going to lead this off, and to Sebastian Edwards, who's going to take the next role. Is it a big problem or none at all? Larry, it's up to you to answer these questions.
Well, thanks, Ed. It's a terrific pleasure to be with you and your guests at this conference, and to see Sebastian. Hi, man. I don't know how many people know that Ed ran for vice president in 2016 as a write-in candidate. I understand he's going to run when he's a little bit older and of age. He's going to run for president next round. So delighted to announce his candidacy. I happened to be on the ticket with him back in 2016, but I think the mistake was we didn't have the right order in the ticket. So I'm going to fix that the next time around. Anyway, so this is a very important topic. We're running 6% inflation. It seems like a 30-year high. We haven't seen these kinds of inflation rates. You know, we're talking about inflation in the future, but I think it's important to realize that there's lots of people that are living on fixed incomes who just saw their fixed incomes, the real incomes drop 6%. A lot of people who, realize the stock market price earnings ratio is very high, and had pulled out maybe 6 months ago, a year ago, holding cash. They saw their real assets decline 6%. So just running 6% inflation in a given year is a real burden on the public and a real bonus to the government, because the real value of the government debt declined by 6% over the course of the year. And people, I think, anticipated about a 2% decline. So there was about a 4% really of GDP, since official debt is about 100% of GDP, 4% of GDP of tax there that was collected by Uncle Sam. So the inflation is a fiscal instrument that the government uses, and it doesn't have direct control over it. I want to talk to that, and also to the fact that, and Ed, you tell me how much time I have, because as you know, I could go on.
Yeah, you have 14 minutes more.
14 minutes. Okay. Cool. Okay. So let me first of all talk about this term deficit. So we're showing some pictures of official debt. You know, it was about 35% of GDP back in 2008. It's now 100% of GDP. If we talk about debt in the hands of the public, not gross debt, but net debt as measured by the CBO. And that's quite striking. But if you look at the debt of the Social Security system, that's not 100% of GDP. It's 250% of GDP. It's about $59 trillion, according to the latest trustees report, which came out a couple months ago. And the increase in the unfunded liability of Social Security, if you look at table 6F1 this year versus last year, that's about a $10 trillion increase. So the deficit we ran in Social Security last year was much larger by a factor of at least 2 than the official deficit we ran. So what we're doing is we're running a lot of, if you like, deficits off the books. We're hiding the bacon. We are taking money from young Ed as he's, let's say Ed's working this year, getting paid a salary, and I'm Uncle Sam. I can come to him and say, hey, give me some money and I'm going to pay it back to you in the future. Now, if I say to Ed, look, Ed, here's an IOU in exchange for the money that you give me, and the money I'm going to give you back in the future, I'm going to call debt service. I'm going to call that return of principal plus interest. Then this money I take from him gets added onto the books as additional official debt. If I come to Ed and I say, look, Ed, I'm taxing you money now. The money I'm taking you from now is taxes, but I'm going to pay it back. I'm going to pay it back in the future. And that I'm going to call a transfer payment, a benefit payment. Well, the same money is involved in both cases. I'm just applying different words to it. So in the case of the second set of words, I could call the money I take from Ed Social Security taxes, and then the benefits I promise to give him back in the future, which could be many, many times larger than the taxes, I can call Social Security benefits. Now, the difference between this one choice of words and the other is that those future Social Security benefits that I'm obligated to pay to Ed are not being put on the books. They're off the books obligations. And we have off the book obligations, not just to Social Security, but to Medicare, to Medicaid payments, to Obamacare subsidies, we have about 18 different federal benefit programs, Section 8 housing, WIC, food stamps, welfare benefits, TANF. And then we have all kinds of benefits embedded in the tax system, like the Earned Income Tax Credit, child tax credits. So what one has to do to really get a handle on the fiscal position of the U.S. and of any country, independent of the choice of language, the members of Congress is using language. They're labeling certain money they grab from Ed as official borrowing and certain money they grab from Ed as taxes. They're just labeling it in order to keep the official debt looking small, because nobody pays any attention to the stuff that's off the books. But economists have to do that. We have to measure what's called the fiscal gap, and that involves putting everything on the books. So all the outlays, no matter whether you call them debt service or Social Security benefits or defense spending or healthcare subsidies, all this stuff has to be projected, which the CBO does project. And then you have to compare that in present value with the present value of the receipts. And you should be discounting these streams at the marginal product of capital of the economy, really the real return the economy can earn on its national wealth by investing both at home and abroad. And that turns out to be at least 6% real. So in the last decade, it's been more about 9.5% real. So we've had a pretty high return on national wealth. If you calculate that by looking at the financial accounts and the national accounts, combining the data together, and then kind of back out the return on national wealth, you'll find that on average, it's averaged about 6.5% real in the post-war. So anyway, when you do this fiscal gap accounting, our fiscal gap is about the present value difference between the projected path of outlays out to the infinite horizon projected by the CBO, and you have to extend their projection beyond how far they go, and the different and also the difference between the outlays and the inflows, the receipts in present value is about 160 or so trillion dollars. Now, that's roughly 8% of GDP year in and year out through the end of time. That's the additional, if you like, primary surplus we need to run in order to be able to come up with the additional taxes or reduce our spending so that we can meet, well, let's put it this way, that we have to raise taxes by 8%, have taxes, path of taxes that are 8% higher as a share of GDP year in and year out through the end of time in order to pay for the path of spending that the CBO projects. That's the bottom line situation. Now, if you go to the European Union, they produce a report called the Fiscal Sustainability Report every 3 years. And the most recent report shows that the that 8% number for Italy, for example, is not 8%, it's 2%. Italy has a much bigger official debt to GDP than we do, but they have much smaller off the book debts. So their fiscal gap is actually much smaller as a share of the present value of GDP. So they're in a much better fiscal gap situation than we are. Germany, France, they're in about a 3%, maybe 4% situation where they have to, where they're short that amount of GDP on an ongoing basis. But by far, if you leave out Luxembourg, which seems to be in trouble, we're the worst country of the developed world. If you do this analysis for China, not so clear given the numbers, but they look to be in bad shape as well, probably around 8% of GDP. Russia is also around 8% of GDP. But among the developed countries, advanced countries, the US is in far worse shape. Now, countries that run fiscal gaps over extended periods of time tend to try and deal with this problem of a shortfall of taxes to pay for the spending by making money. By that, I mean by printing money. So we've seen the federal government increase the monetary base by a factor of 6 since 2008. If you look at the Fed, the St. Louis Federal Reserve's data, and just Google the monetary, check the monetary base, you'll see that it's increased by a factor of 6 since 2008. Now, a lot of this expansion of the Fed's balance sheet involves portfolio transactions. So they'll print up greenbacks, just, obviously they do it electronically, but let me just do it kind of figuratively, print up dollar bills, go out there and buy a General Motors bond. And now there's more money circulating in the economy. There's more there's more securities in the holdings of the New York Fed, which is doing the transactions. So you might say, well, this is inflationary because if you're Milton Friedman, we've got a much bigger monetary base. If you go back to the quantity theory, MV equals P times Y, V being the velocity of money, M is the quantity of money. Well, the quantity of money just went up by a factor of 6. V went down it fell like in half since 2007. And P has gone up by not much, and Y has gone up. So we do have the basis for P to go, if we really believe the quantity theory, P to dramatically increase. We could have an increase in the price level. If you're Milton Friedman back in 1950 or 60, you might say the price level should be really 4 or 5 times higher than it is today. Now, the response would be, well, the Fed, if it starts seeing inflation, can easily take that General Motors bond, sell back in the market, suck back the greenbacks, and reduce the money supply so that we can't, it has a wherewithal to control inflation. Of course, that would lead to interest rates going up. And it may be that the GM bond isn't worth as much as when they bought it. But they're reluctant, I think, to do that because they don't want to impact interest rates and potentially put us into a recession. And then we also have the Fed buying up treasury bonds. And whether it buys up treasury bonds or GM bonds. It's really in terms of just standard old monetary finance where the Treasury prints a bond, takes in money, buys a chicken for the president's lunch. The money it takes in, hands it back to the private sector for the chicken. That keeps the money supply fixed. Then the Fed goes and buys back the Treasury bond with newly printed dollars. That means there's more dollars out there, and the government has the chicken. That's the typical, let's print money to buy the chicken. Let's combine the Fed and the Treasury together, look at them together as printing money to buy, to pay for government spending. That's also taking place here. And by the way, whether they buy the Treasury bond or the GM bond doesn't matter for this particular issue of printing money to pay for government spending. So we can't really tell from the bookkeeping for reasons that are intentional. The Fed has kept the books in a way to obfuscate, to obscure how much money it's printing to pay for government spending. But when we see the inflation take off, we can feel the real tax there. And we know there's been a real transfer from the private sector to the government. And also we're hurting people that are on fixed incomes like pensions. You know, a lot of people that are, receive pensions in their from work. We used to have a major DB system in the corporations. We also have a lot of state and local pensions that are not indexed for inflation, like the people in Detroit who got a settlement, the firemen and policemen and teachers who got a settlement when Detroit went bankrupt. They're on pensions that are nominal. They lost 6% of their future spending power, not just for this year, but for the rest of their lives, just in 1 year. So inflation is a major concern. And I'm also concerned that there's an expectation element here, which is if you start to expect that the country, if you start to understand how broke the country is, if you understand that we had 22 hyperinflations in the last century around the world, that each of those countries was in fiscal trouble, the countries that get in fiscal trouble start to run inflation, then you start getting in your mind that there's going to be inflation. And then money can become a hot potato. And I said to myself, I got to raise prices because I can't do this every 2 weeks. My customers are going to get upset. I'm going to do it periodically. I'm going to raise prices in anticipation of other people raising prices within the year, my competitors. And now we have inflation kind of taking off on an expected value basis where people don't really know truly what's going on. I just want to give one analogy, and I know I should probably stop at this point, but Sebastian can correct me because he knows more about South America than I do, but when the Christmas were running the economy, I'm mispronouncing their name, they're running the economy, they're putting out data from the central bank about the printing of money, about the money supply, and apparently nobody trusted it. So how does the public understand the printing of money to pay for government spending in a context where they can't see how much money is being printed? Well, it's kind of any woman's guess, and they start kind of people form expectations, not here, not just in Argentina, but around the world. The Argentine peso devalues every day, and you have the private sector setting their prices every day, raising the prices every day, corresponding to how much the peso devalues, but nothing's kind of grounded in reality because we don't know what the reality is. So that's the sense in which we could have ongoing inflation. Maybe it's triggered by these supply chain issues, but it doesn't take much to trigger changes in expectations. We saw that when Lehman Brothers collapsed, in one day, all hell broke loose in the financial system. In one day, when Volcker announced he was going to start targeting the monetary aggregates back in, I think, 1979, he never, ever, ever targeted those monetary aggregates. What he said were going to be the targets, he never hit. If you look at the data, there's actually no change in monetary policy. He said some words, the markets went nuts, interest rates went up to 20%. We had a recession, which was pretty much as large as the Great Recession in 81, 82. We should not have called the Great Recession great because there wasn't too much great about it compared to that one.
Larry, we're running out of time here.
Let me just stop and say that I'm like Ed. I'm a inflation pessimist because fundamentally, we are broke. Our country's broke, and nobody in government is talking about, no, there's not a single economist in Washington. The only person talking about the long run impact on our kids of all this, these obligations we're leaving to them is Senator Manchin, and he's getting all kinds of, hell as a result.
Okay, thanks so much. Don't go away, Larry, because we've got the student questions pouring in. A lot of them are going to be aimed at you after we hear Sebastian. Sebastian, the stage is yours.
Thank you, Ed. Thank you, everyone. It's a great pleasure to participate in this meeting. I'm on sabbatical this year, so I haven't been to campus for quite some time. So it's great to walk around and see the students and come back to what's been my home for a very, very long time. So Ed and Larry have asked almost all the right questions and have provided quite a few of the answers. So what I'm going to try to do is go through some of the issues that have been raised and try to comment on them. And what I will also try to do is to do it from an international perspective, as Ed said. So let me start with the first question that Ed asked, and that is, do we have too much debt? What is the limit? How much is enough? And Ed then showed the bar chart with different countries. And at the very top is Japan with 240, 250% of GDP. And we have around 100, the different numbers. Larry was talking about 100%. My data says 130%. We're not going to quibble about 30% of GDP. It's just a few $1 trillion. But we have a pretty high rate, although Ed said it's in the middle of that chart. But how much is enough? Do we have enough? Paul Krugman has been saying, well, maybe we have room to go to where Japan is. So the answer is we don't know. As plainly as that, we have no idea. So we started in the late 90s with 60% was the limit. And it was the limit because it was a little higher than what we had. Ed showed that until the Reagan tax cuts, it was about 40%. Then it went to around 55%. And then with the great financial crisis, it went to 90%. And then now it's 120, 130%. Okay? So that's the way it's been going up. And the nation has not disappeared. And the dollar continues to be the main currency. We are living pretty good life. I just came back from South America, 2 trips in a row. But if you talk to Europeans and you talk to people in Asia, we are doing okay, and the debt keeps going up. So what's the max? We don't know. How did these numbers come about? Well, 60% came about, as I said, in the late 90s, because it was a little higher than what we had, and it was declared in a very arbitrary fashion to be the maximum debt to GDP that countries that wanted to join the euro could have. Why did they pick 60%? Because that allowed every country in Europe to be in except for 2, Greece and Belgium. The Belgians did structural adjustment and brought down that debt in a real way, and the Greeks sort of finessed the accounting and transformed whatever it was into 59.999. They were let into the euro, and the rest is history with the Greek crisis. So we don't know. The only people who seem to know are the Germans, who after the great financial crisis introduced a constitutional amendment that sets a limit to the debt to GDP, the federal government debt to GDP at around 60%. So if you look at the international data, you see the 60%, or around 60% until 2008, then the jump to 90%, which became the new magical number. Why? Because that's where all the European countries went and the US went to. That generated within the economist community a big fight. Ken Rogoff and Carmen Reinhardt on one side, and then Paul Krugman on the other side, whether 90 was the absolute limit. Rogoff and Reinhardt said if we went above that, it would be the end of the world. But the Germans said, no, we have to bring it back to 60. And what you see after 2008, every country, European country, OECD country, stays at this higher debt after the crisis, except Germany, that goes down to 60. Now, after the pandemic, Germany is at 90 again. And they were talking about bringing it back to 60. They introduced a release to what they call the debt brake in Germany. But if you read the Financial Times yesterday, the most interesting story was about the new chancellor in Germany, Mr. Scholz, finding ways to get around that constitutional limit of 60%. And they are becoming very creative in ways that I think Larry Kotlikov would find amusing, but would not approve of, including that there are a lot of items related to the pandemic that are below the line. So it's real spending, real debt, but it's not counted as debt. The other thing they're doing is that they have a development bank, and they are going to allow the development, they're going to use the little room that they still have on the debt before the brake is released, and or they go back to the brake, let me put it that way, and they're going to add some equity into the development bank. But banks can lend 20 times their equity. So they're going to increase debt through the development bank and through some of the state-owned enterprises. So the point that I'm trying to make here is that even if you think you know what the debt is, the debt limit is, as the Germans do, and you become very serious about it by introducing a constitutional amendment, you can get around it and you can cheat. And we go back to the Larry Kotlikov world where we really are worried and become very pessimistic. So I spent a lot of time talking about Germany. Let me go through very quickly through what the notes that I've made. So Ed asked, is there good debt or bad debt? And that brings us to something that economists have been focusing on for quite some time. And in terms of jargon, that is the R minus G question. R is the interest rate, and G is the rate of growth of the economy. And why is that important? Well, because we are measuring, as Ed and Larry did, debt over GDP. So debt at the very, if you issue more debt to pay the interest bill, and Ed talked about that, then the numerator, or as my grandmother said, the upstairs will grow at R, and the denominator, or the downstairs, will grow at the rate of growth of the economy, G. And what really matters is R minus G. And that's the point that Ed made by showing how interest payments have gone down. R minus G determines what the primary balance is, the maximum primary balance a country can run that is consistent with a stable debt over GDP ratio. In most emerging countries, R, the interest rate they have to pay on their debts, this is all real, in real terms, exceeds the rate of growth of the economy, except in countries like China. But in Argentina, a country that Larry referred to, it has to pay a very high interest rate because it has a huge country risk premium, and it barely grows because it's managed by a bunch of incompetent people. So R exceeds G, that means that they have to run a primary surplus every year. And that squeezes expenditure on social programs. That generates an additional social, political upheaval and political risk, which feeds into even higher interest rates, and you get into this negative spiral that the RGs have been in for a very long period of time. So the thing to worry about is R minus G, and that brings us back to what Ed was saying. Is there a good debt? Is there a debt that results in higher G? And that brings us to the whole question of infrastructure and the issue and the infrastructure program that the Biden administration just passed, and the Build Back Better, is that BBB program? And in particular, an issue that we haven't discussed is whether issuing debt to fund programs that help accumulate human capital are the type of programs that we can relate to good debt. There's been a lot of push in that direction, from all over the place, including Jim Heckman at Chicago. And of course, it goes back to Gary Becker and human capital, and back to T.W. Schultz and the early stages of the human capital theory. So this is something to look into. Another point. So I'm going to go through different points. Larry has spent his career in voicing and telling us of the dangers of contingent liabilities. And he started by saying official debt, official debt, official debt. And the reason he's saying official debt is that then we are not counting the unfunded liabilities that are related to the health service and to Social Security. And he's made very, very compelling arguments that once you take those into account, we get into real trouble. So I'm not going to get into that. I want to look at another measure of debt that was completely absent in the discussion so far. And that is the NIIP. Okay, so we love acronyms. So that's net international investment position of the country. And that is the net debt position of the country as a whole. And it takes into account the corporate sector, households or families, and the government. And the NIIP of the US has gone up since 2016 from around, let me see, $8 trillion to $16 trillion. So it has doubled. That means that two things that most people don't know: the US as a whole, once you consolidate all the accounts, is a very large international debtor, which is surprising. You would imagine that advanced countries are creditors and poor countries are international debtors, because that's the way money should flow. But the US is a huge debtor and it has become much larger. Question: does that mean that the dollar is in trouble and it is about to be replaced by some other currency? And I think that the answer is not yet, but this opens up an issue that I'm surprised that neither you or Larry talked about, although you talked about inflation, and that is digital currencies. So both of you got it right. You said a lot of money, in particular if there is what economists call fiscal dominance, so money is printed either directly or indirectly to pay for the chicken that is going to be served to the president of the United States, according to Larry's metaphor, whether printing that money is going to generate inflation. That's, you got it right there. But I go back to, and now if I want to think from a perspective of the history of economic thought, to Don Patinkin and everyone who's worked on money and inflation. What really matters is excess supply for money. And excess supply for money, for dollars. It's what monetarists and Friedman used to say, inflation is the result of too much money chasing after too few goods. Now, the too much money part can come up in two ways. One way is if we print a lot of money, and Larry and Ed went through that, and we do it electronically, and we create reserves for banks and so on and so forth. But it can also come around the too much money part by the demand for our currency collapsing. And the question is whether digital currencies, either private currencies or central bank digital currencies, CBDCs, are going to result in a decline or a collapse in the demand for other currencies. So let me give you an example from an international perspective. So Ed, I'm running out of time, but Ed asked me to look at this from an international perspective, and the country that Larry referred to, and that's Argentina. If the Fed or the Bank of Canada or the Bank of England or the European Central Bank issue their own digital currency, so instead of me having to carry $100 bills, as many Argentines or all Argentines carry in their wallets, I have it in my pocket. Why would I hold Argentine currency? I mean, as Larry said, we don't even know how much they print. So there is a possibility in the international arena that once central banks start issuing CBDCs, the demand for a whole bunch of currencies is just going to collapse, even if governments force people to use that currency to pay taxes with. Because of course you carry dollars, which more or less, I mean, we're losing 6% per year. That's nothing compared to 60% in Argentina. We carry dollars in our iPhone, And then the day we have to pay taxes, we just exchange them for pesos, pay the taxes with pesos, and so on and so forth. So I think that this whole discussion has to bring in these advances. Let me just finish with one additional question. Will we have a crisis, a big crisis, a real crisis, one where we restructure our debt or we default on it? Well, in my last book, as Ed pointed out, I looked at one such episode in the US, which happened not that long ago. It happened in 1933, between 33 and 35. And that was when the Roosevelt administration devalued the dollar relative to gold. And this is the restructuring part, annulled all contracts that had been written in terms of gold, and transforming them retroactively into paper dollar contracts, imposing a loss on investors of around 40%. And the interesting thing, and I'll stop here, is that the Supreme Court declared that that was okay. There were 3 big cases, and in February of 35, the Supreme Court ruled in a way that we don't have time to get into, that it was okay to retroactively change contracts and imposed a haircut on investors of 41%. So the question, and I leave this for you gentlemen, is whether you think the Supreme Court could do that, not now relative to contracts that are in gold, but Social Security contracts that they have with all of us. Thank you, Ed.
Okay, thanks. That was great. I'll give you a little clap. We have some, I have one question for Larry Kotlikoff and one for Sebastian. Larry, had you become president, I heard you say in your presentation just now, you would end Social Security and Medicare because they're not affordable in the future. What are we going to do about those unfunded liabilities?
No, on Medicare, I would put everybody into Medicare Part C and use the competition of that system and to bring down national spending on healthcare from 18% down to about 12%. And that would be the way to rescue the next generation from these terrible bills that are heading their way. As for Social Security, I would, if you go back to our platform, Ed, I would freeze the current system, pay off the accrued liabilities, and put everybody into a system where we all invest in the global marketplace by a computer, not through Wall Street brokers, but where the system has got progressive contribution matching and all the other nice features we'd want in a modern compulsory savings system where everybody gets the same rate of return in a given year. But let me just say one quick thing about this R-G issue. If.net, look at and click on articles, they'll find article 5 and 6 from the top, a couple articles recently with co-authors on this difference between R and G that people are claiming is a rationale for running deficits because it's so cheap to do it right now. That's kind of implicit in Ed's chart that the servicing of debt is so inexpensive. But I'll just give you one example of the many in these 2 papers of why that's not necessarily the case. Suppose that that we're running, let's say, which we're doing a Social Security system that's unsustainable, and that the people holding government debt think that their Social Security benefits could be cut dramatically in the future. Well, then their desire to hold something safe, namely government bonds, if they think there's going to be default on Social Security, but not on official debt, then official debt becomes the safe asset. That can drive down the interest rate. So the worse things look in Social Security, the lower the interest rate, and the more it looks like you can run even more Social Security. You can run an even bigger Ponzi scheme because it looks even cheaper and cheaper. So the more the Ponzi scheme you run, the better it looks, even though in terms of the expected impact on future generations, it's worse and worse. You're doing more and more damage. So we have.
Larry, I got to cut you off because I got to make sure we have the student questions. We have some questions from.
Yeah, we have one for Larry. What are the critical variables in fiscal gap calculation? Does population growth or would immigration help?
Well, the population growth is already embedded in these projections that's projected by the U.S. government. and it's enormous. We're projected to increase our population by the size of the Philippines through the end of the century, 120 million people, increase the population by a third. If we get, the kind of immigration we've been having in past decades. So that's certainly included. So if we have more immigrants, and we give them more benefits when they come, it's not the case they're going to pay more taxes, but if we bring in high skilled immigrants, it's a different story, but that's not the way our immigration system works. We're bringing in primarily low skilled people for whom we're not making any money on net on. They're not costing us anything in terms of the fiscal gap from the most recent study of this, but they're not making us money. So the answer I would say would be no, unless we change immigration policy. But if we start going after the high skilled people, everybody else will as well. And there's not that many around the world.
So just to be clear, had he become president, he would have cut Medicare and opened up the borders so all the immigrants would come to the United States.
High skill, he said.
High skilled, yeah. Is there another question?
Medicare for all, Part C. That's what you want. You would have been in charge. I would have put you in charge of it.
We also received a question for Sebastian. Do you see a difference between countries which have their own currency and countries such as those in the Eurozone which have to borrow in an external currency?
I'm not sure I heard the question, but I'm going to answer the question that I want to answer, which is related to the question that was asked. I think that we may very well see, with all the technological advances, countries getting rid of their own currency and moving in some direction. Now, the one example that we have is El Salvador, which made Bitcoin legal tender, but it hasn't worked. And there's been a lot of questions, and the collapse in the price of, well, first the run up of the price, and then the collapse of the price of Bitcoin has generated a lot of problems. And there are lots of question marks related to whether there is some corruption behind it. But I think that the way this will work is through advanced countries' central banks are going to issue digital currency sooner rather than later. And once, say, Canada, which is very advanced, does it, it's going to generate a domino effect. And as I said, let me just add one thing. In the European Central Bank, some of the members of the board are arguing that there's going to be a limit on how many euros people can hold for retail use, 3,000 euros. But I can go into a website and for about $15 a year, I can get VPNs from all over the world, and I can have multiple accounts with 3,000 euros each. So countries like Argentina, I think, will eventually have no currency of their own, or maybe just a unit of account. Panama has no currency of its own, but it does have a unit of account called the Balboa, but they don't issue any. And it's one Balboa, $1.
I'd like to have a follow-up question. Is there a difference between debt that is held by internally in a country versus externally? Isn't part of the Japanese story, the vast majority of their debt is held internally, it doesn't raise exchange rate issues?
No, I think that there is a difference, but it goes both ways. So in the case of Japan, the Japanese population, the families and people have a great amount of trust in their government, and they think that they will do the right thing. So it does make a difference. But in the case of Argentina, just to stay with Larry's favorite country, it's the other way around. I mean, people really don't trust Argentina. They keep restructuring the debt again and again and again. And they are now in the midst of a discussion with the IMF, where they want the IMF to forgive some of their debts. They are in arrears. Very few countries ever get into arrears with the IMF. Argentina is in arrears with the IMF, or wasn't. I mean, I haven't followed the last few weeks. And they are trying to get some kind of forgiveness. So it does make a difference, but it depends on which country you're talking about.
But just to be clear, I wasn't talking about the willingness of the Japanese to hold the bonds. I was saying if the Japanese investors said, we don't want to hold these government bonds anymore, you wouldn't have an exchange rate crisis. You'd have an increase in the interest rates internally. So you wouldn't have a Mexico or Argentina.
Right. Most advanced countries don't issue debt in a currency that is not their own.
Yeah,
We
exactly.
issued samurai bonds sometime, maybe Larry remembers exactly when. I think it was late 70s or early 80s. Very briefly, and a very small amount of yen-denominated bonds issued by the US, but it's very unusual.
How about another student question?
Yeah, we have one for Larry. Given the current high US debt to GDP levels, do you see either A, a cap on interest rates, or B, expanding spread on real estate on current bond yields?
I don't see a cap on interest rates. I don't think we're going to go back into the 80s. We had some experiments with like capping interest rates that led to a lot of financial problems. The second part of that was, give me the second part of that question again.
It was asking if you foresee expanding spreads on real estate current bond yields.
Well, I think if the economy, starts looking more risky, and if real estate looks, if any sector looks more risky, there's going to be a bigger spread. I want to kind of answer another question that I want to answer, which is about, why interest rates are low. I mean, part of it is kind of what Sebastian was referencing, all the riskiness associated with the rest of the world. The US, despite our COVID experiences, where the Republicans are committing suicide around the country, that doesn't seem to be a national risk. Maybe that's a sign of safety in some sense. And the fact of the matter is, if the rest of the world views itself as riskier, there's going to be a movement to buy US bonds. We're going to print more of them. We're going to save less as a consequence. We're going to consume more. We're going to then crowd out global capital because we're going to participate in, we're going to reduce the world's supply of saving. And so we're going to beggar thy neighbor. So part of what we're doing here is expropriating not just our kids, but the rest of the world through issuing so much debt, official debt at such low rates. And it's due to the fact that foreigners are buying up a lot of that debt because of the uncertainty abroad. So we're taking advantage of that, and we're taking advantage of foreign workers in that process, because if we save less, there's going to be less global investment, less capital for those workers are there and here to work with, and lower global wages.
Okay, I'd like to hear the forecast from both of our speakers for the real rate on 10-year treasuries, the sovereign debt, not just in the United States, but on a global level. Aren't we all surprised how incredibly low these
-4
rates?
right now.
And so what's it going to be over the next decade? Is it going to be so low that debt is just nothing we need to worry about? What do you think, Sebastian?
I think it's going to stay pretty low, but not as low as it is right now. I mean, if you do the Fisher equation using point estimates, it's -4%, the real interest rate. So 6%. The nominal interest rate on the 10-year note is, 1.4 in nominal terms, and inflation is 6.5.
Yeah.
So you just subtract one from the other, and you get -4, -4.5. So we're not going to see that going forward on a permanent basis. But I think it's going to be very, very low. But maybe all this infrastructure spending is going to generate higher rates of return on private investments, and we're going to see investment boom, and we're going to get out of the secular stagflation that Larry Summers was talking about.
But for interest rates, they're decided at a global marketplace, not just in the United States, right?
They are decided in a global marketplace. So globally, the question is whether we're going to have lots of new attractive investments related to the green economy and say green hydrogen and all of that. And on the other hand, whether German retirees are going or German workers are going to continue to save more and more in order to spend their retirement years in the south of Spain baking in the sun.
Yeah, so he's saying more investment opportunities and less savings would give us higher interest rates. Larry, do you have an opinion on where interest rates are going?
Yeah, let me say I wouldn't get near bonds right now, nominal bonds, because the risk of inflation being dramatic. I mean, you know, especially saying we got a 6% inflation now. The long-term treasury suggests the inflation rate is going to be 2%. Well, I wouldn't count on that. I wouldn't be investing in 30-year bonds and see my money wiped out in real terms. I wouldn't be investing in 10-year bonds. I would try and buy something, IKEA furniture, a home, something real that you can actually sell, because I just think the market's nuts here on this, and that interest rates are going to go up, and inflation is going to be much higher than it's going to be. I don't see it coming down dramatically anytime soon. I think what we have is the prospect for very high long-term inflation because we are broke. That's fundamentally we can't see it from the Fed's numbers per se, but certainly it looks like they're printing money to pay for the government's bills. I mean, you can't say they're not from the data, but we know that the country is fiscally broke and not even addressing it, not even publicly acknowledging the long-term fiscal gap. The Congress will not force the CBO, the GAO, OMB to do long-term fiscal gap accounting like they do in Europe. There was a bill that was introduced by the Senate. It got 8 senators to support it. It was called the Inform Act to produce fiscal gap accounting every year by these agencies. Only 8 senators supported it. That tells me everything you want to say about inflation.
Okay, that's all.
Can I add something very brief for the students to look at? So take a look at the implicit expected inflation from the difference between the 10-year note and the 10-year tips, and then do it for 30 years. They crossed for the first time about 3 months ago, meaning that people are expecting the longer end to have higher inflation than the short end.
I have so much more to say, and each of these gentlemen do too, but we have no more time. In fact, we used more than we could. So come back some later time and we can put it back together again.
Exactly. And thank you so much, Larry and Sebastian and Ed, for an incredible panel. And hopefully next time we'll have a live audience. So please join me in thanking our panel. And this brings our last UCLA Anderson Forecast Conference for 2020 to a close. Before you click Leave Meeting, just a couple of announcements. In March, we have our next conference, and it's going to feature trade. Our keynote is the CEO of the Port of Los Angeles, Gene Soroka, and we're going to have another great panel, so stay tuned for that. I'd like to also just take a moment to thank our sponsors. We could not do this program without our sponsors' help and support. And so our principal sponsor today is RSM. Our platinum sponsors are law firm of Allen Matkins, Cafe Bank, Clark Construction, Leap Development, University Credit Union. At the gold level, Bank of California, California Bank and Trust, California Steel Industries, Venture Forward by GoDaddy, Robert Half, and Wells Fargo, the private bank. At the silver level, Hathaway Dinwiddie, Lansing Homes Pacific Western Bank, Union Bank, the private bank, and United Airlines. At the bronze level, Cal Private Bank, Hanmi Bank, HDR. And at the Bruin level, Gerber Kawasaki Wealth and Investment Management, Point Wealth Capital Management, SoCal Gas. Our media sponsor is the Los Angeles Business Journal. And we also want to thank the support in co-sponsoring this event of the FINK Center for Finance here at UCLA and our students from the Anderson Investment Finance Association. And on behalf of UCLA, the UCLA Anderson School of Management, and the UCLA Anderson Forecast, we wish you a very happy holiday season and a prosperous new year, 2022, the 70th year of the Anderson Forecast. So thank you very much. This brings our program to a close.